I funded over $500 million in private loans over the last 19 years with private money only, no banks or institutional capital. And consequently, I've learned the biggest mistakes that lenders make. So, in today's video, I'm going to reveal three costly mistakes you must avoid if you're lending money so that you can deploy capital the right way to build generational wealth. Let me share my screen with you here real quick. What are the three costly mistakes? Number one, not fully knowing and understanding the collateral you are lending on. Very important. Number two, not having full control over your capital. Example, are you using bank lines that potentially could get yanked in any down market? Are you using one investor that is deploying all their capital through you that they decide they don't want to be in business with you anymore? You need to have funds that you control so you get to make the rules and know which loans you want to do and what you don't want to do. And don't even get me started with institutional backed lenders or institutional backed capital. You have no control over there, right? So we're going to talk about capital. Write that down real quick. And then lastly, we're going to talk about your team. Do you have the right team, employees, attorneys, insurance? I'm going to discuss the exact team that we use inside our lending business, Hard Money Bankers, every day. The third mistake of the team is the one that holds 90% of lenders back and not being able to grow into a scalable company. In fact, I've never seen anyone succeed until they overcome that hurdle. Seems easy, but it's not at all. We're going to go through our exact team and everything else on collateral and capital as well. And soon I'm going to show you exactly how we overcame these costly mistakes over the last 19 years of running Hard Money Bankers. Now, avoiding all these mistakes is honestly the key difference between a crappy loan portfolio and a thriving loan portfolio. And it's actually easy to manage a profitable portfolio. It is a pain in the neck, and you will lose capital, investors, and money if your portfolio is not clean. Now, just to recap, I've done over $500 million in loans. I've helped hundreds of other hard money lenders scale their lending businesses from $1 million deployed all the way up to as much as $100 million deployed annually. So if you want to learn directly from me and get access to all my systems and processes to literally make sure you scale your lending business profitably in the right way and to avoid all of these costly mistakes, then click the link below to apply. Before we get into it, I need to quickly touch on why right now is the best time to go all in on your hard money lending company, because the hard money lending market is entering a new boom in 2026. Bank lending has always been strict, and institutional capital has been tightening up, especially for fix and flip, new construction, and alternative assets like small balance commercial properties that banks really just don't want to lend on. There are a ton of low LTV, loan to value opportunities out there. That means this is a golden opportunity for hard money lenders to scale quickly, but only if you know how to avoid the pitfalls people use to fall prey to. Let's just jump in right away and go through all this stuff. It's so important to know the exact collateral you are lending on. This is the most important thing. We are collateral-based lenders. And as the first mortgage lender, you should have the least amount of risk, but you have to know what you are lending on and structure the loan safely. I talk to hundreds of private and hard money lenders across the country. Most of them don't fully know how to underwrite and review the collateral that they're actually lending on. They don't know the areas. They're relying on third-party appraisers. It's costing them tons and tons of money on deals that go sideways, and they have a defaulting portfolio, which in essence takes 10x the amount of time and energy to bring up a defaulted loan into a performing loan compared to just doing and writing good loans on good pieces of property. So we follow what we call the 4 C's: collateral, character, capacity, and credit. All of them serve a purpose, but understanding the underlying collateral of what you're actually lending on is the most important part. Do you have access to your local MLS? Do you have access to software and ways to determine what the actual value is? I like to tell a story all the time. If 3 people were flipping a property, we'd all sell for different prices. One of us might have more experience in that area. One of us might know the exact way to structure the property. What I mean by beds and bath counts, things like that, paint, flooring, fixtures that a potential buyer would need in that particular area. And the reason we don't like using appraisals is because they don't know the background of the borrower. Did this borrower flip 100 houses, or is this their first deal? They don't know those things. You know those things as the underwriter, as the owner of the hard money lending company. So it's important that you make the decision of what you believe the property is worth and what it will resell for. I'm not stating that you don't talk to real estate agents and brokers and other real estate investors and appraisers to help you determine your value, but you have the economic interest in the property. You need to be the one making the decision of what you believe the property is worth. Now, keep in mind, if you're in a nice, easy residential subdivision, let's say there's 300 or 400 properties in that subdivision and they're all built after the 1970s, those are easy to value. But when you start getting into cities or you start getting into properties that are sitting on double yellow line road or highway, those are harder. You have to get creative to figure out what's worth. I'd encourage you to go to the property. I'd encourage you to meet with the borrowers, understand exactly what you're lending against and understanding how to value properties. Our lending company lends locally in areas that we only know. I'm not saying that you can't run this business out of state or in another area, but it's got to be an area that you fully know. A clean portfolio is good for you and it's good for your capital investors. One of the most important things is to make sure your borrowers are bringing proper down payments, 20%, 30%. Stop giving them 100% financing. You don't need to compete with Kiavi and do a 5% down loan at a sub 10% interest rate. Industry terms for hard money and private lenders are 12, 13, 14%, 2, 3, 4, 5 points with a 20%, 30% down payment. Stick to that. That works. I know a lender in Tennessee who I've been friendly with for a long period of time, and they started at 100%. And they originally came to us because they were scared to ask their borrowers for larger down payments since they thought they were going to lose business. But they also understood the importance. So the recommendation was, well, you know what? Start small and then work your way up. Maybe you have some good repeat borrowers. You want to continue at high leverage, even though it's still risky. Maybe start with that. But then moving forward on newer clients, maybe start at 10% down and then keep, the existing terms on your old borrowers. And then they realized, wait, everybody's okay with 10% down and I'm still nervous. Great. So move to 20%, move to 30% down. If you do a loan at 100% financing to a borrower and they default on the loan, you're not only not going to recoup your money, your interest, you're not recouping principal. You're going to lose money. You need to be very, very, very safe. So if you want to learn directly from me and to get access to all of our systems and processings to literally make sure you scale your lending business profitably in the right way and to avoid all these costly mistakes, then click the link below and apply now. In this business, we've seen it all. We know exactly who is going to default and who is not going to default based on their ability to execute. If they're buying the property at the right numbers, do they have credit that will support them executing, making payments? Do they have the capacity? And do they have good characteristics? Good characteristics is so underlooked. They have to have good characteristics and make sure they're good at communicating and that you trust that even if the deal starts going sideways, they're still going to be able to cover your deal. Let's move on to number 2 of not having full control over your capital. If you see this little slide right here, lack of control leads to business failure, and it does. If you are not making the rules and your capital investors are abusing you, calling your notes, not able to help you get loans closed on time, it's just an uphill battle. It's never going to work. You're going to run into a problem. Even if you have a good performing portfolio, at some point, if you don't have full control over your capital, investors are going to want their money back. They might raise the terms. It's just not a good spot for you to be in. So let's talk about what capital sources you should pursue as a lending company. I've seen too many good lenders ruin their lending business because they just don't have full control over the capital, or even worse, go out of business because they have the wrong capital in place. So these are the examples, good and bad sources on each of them. So obviously with bank funds, there's a few different ways to access bank funds for these deals. They can leverage your loans, meaning a note on note credit facility, or leverage a property portfolio. Maybe you have a rental property portfolio and you want to do lines of credit against that. Obviously it's cheaper and you don't have to raise private capital, but you're contingent on what the bank offers you and they could close that line or call it at any time. And I hate to say it, but you're out of business. And I've seen this too often with lots of lenders throughout the country. And it doesn't always happen just when the markets are rough or markets are going down. It's also when markets are going up. I just saw this a few weeks ago because a bank merged or got sold to another bank. They didn't want to be in this business anymore. And they called every note, $15 million worth of notes. They called, and this hard money lender is scrambling to figure out ways that they can exit this because they're on the hook for it. It's not something you want to do. And also, most of these banks are probably going to have some sort of personal guarantee as well that you're on the hook for. Another thing that I've seen a lot is hard money lenders are doing the right thing and raising private capital, but then they end up hitting a home run and they find capital for 1 or 2 larger private investors that end up just being sharks and they control everything on this. And then one day that lender might not want to do deals anymore. And then you're out of business. They got lazy because you went out and raised capital. And instead of trying to get capital from 10 or 20 or 30 different people, you got capital from 1 or 2 people and they control everything. And they know that you need that capital. So all of a sudden, they're changing your underwriting standards. They're telling you what you can lend on, what you can't lend on. No way to run a business. As you're raising private capital, you need the flexibility in order to be able to control the deal flow as they go. If you have a deal that defaults and a borrower's in foreclosure, the last thing you need is your capital investor to be, all over you and harassing you for the capital back, because you're trying to fight this foreclosure. You're trying to get this money back. So it's always good to make sure you're diversifying into things. And with private capital, typically you have a few different ways. You have direct placement, which you can do. That's a popular one, where in essence, you assign a loan directly to the capital investor. Let's say it's a $100,000 loan and you use their capital. It's very popular to use funds. The downfall about a fund that you got to obviously be aware of is making sure that you have enough loans in the pipe to be able to cover the debt service. In the hard money lending space, a lot of the funds are debt funds. So for instance, let's say you raise $5 million and you only have $4 million deployed. You still have $1 million of debt fund interest that you have to pay out to your capital investors monthly, quarterly, or yearly, however you have that set up. On the other side, let's say you don't have that, you don't want to pay that out. You might make bad decisions to do deals that aren't great just because you want to deploy that capital. So again, there's pros and cons of all of these. And then some just have unsecured or business loans from their capital investors directly to the hard money lending company. And by setting that up, it's kind of a similar situation. You have control over what you're lending on and what you're not lending on, and that investor doesn't really have too much control. I do think private capital is the way to go, though. The purpose of a hard money, private money company is to be able to deploy private capital into these particular loans. You just have to make sure that you're controlling the capital the best way. And obviously, we talked about this before. Don't go down the institutional back lender route unless you just want to broker deals and have no control. If you just want to be a sales and marketing company and broker loans with limited liability, there's still real liability, right? Because there could still be buybacks. They don't even have to be fraudulent transactions to get bought back, right? It could be they didn't make enough payments, the company didn't want to, maybe they commit to you to do a deal and they'll buy it off your books and then they don't. I would just be aware the institutional back road is a short-term road. I don't think you're really building too big of a business doing that. It's just a sales and marketing company to bring in more deals. If you want to try to do this as a real business, you want to control private capital that's raised appropriately through direct placement or some funds where you have say of what's going to happen with this thing. Again, if you need help with this, feel free to apply below, links below. Happy to chat with you. Let's talk about building a strong lending team. Typically in a lending team, you need in-house help and outsource services. There's roles in-house that I know some lenders try to outsource. I'm gonna go through those in a second that aren't ideal. And then there's outsourced services and expertise that you certainly need to work with. So let's go through the lending team structure. And this is a structure that we actually use internally as well. And this isn't something that happens overnight. If you only have a few $1 million deployed, you're probably just looking at getting a processor and a bookkeeper. That's usually what's at. And then as you grow, you'll get some other stuff. So let's talk about some of these in-house positions and then some of the outsourced positions. So again, we have a $50 million portfolio. I think as soon as you get to about a $25 million portfolio, you can support all of this stuff. And the best part about it is you can scale above that and you don't really need to take on additional overhead for employees. So a processor in essence is running everything on the front end, right? Like the loan gets originated, it gets sent to the processor, they help get it to closing, they do draw requests, things like that. Everything kind of on the front end, front facing with the borrower. Now, obviously a processor, the personality types are going to be, if you know DISC personality, ideally, you're going to want someone that is probably like a little I, some S, and some C. You want to make sure a little C, you want them to be able to hold down the fort. You want them to be front facing with the borrower and client and have a good overall experience. That's a processor. Bookkeeper, you're typically going to want someone who's more of a C personality, very analytical. Our bookkeeper lives in our loan servicing software. What we use our bookkeeper for is they're in our loan servicing software, they're in their email, they're in our bank, sending wires, processing payments, things like that. Now, when you're starting out, and let's say you're a one-man band and you're like, well, I need to hire someone, where should I start? A lot of people default to a blend of someone that can do the keystrokes and the paperwork, a processor bookkeeper. And I think that's okay to do at the beginning. Just note that these are very different personality types, the processor and the bookkeeper, very, very, very different personality types. So it's challenging to have that one person do both, right? Because if they're a good bookkeeper and analytical, they might not be great on the front facing side and vice versa. So if you're at a position to grow into it, then two would be separate. Also, an inspector is a good idea. When we start out, we're looking at every property, we're going to meeting the borrowers, going to the properties, doing the inspections. It's not just good for underwriting purposes, but it's also good for business development. If I'm doing a loan for a borrower and I go out to the property, I meet them, I check out the property, see if we can lend on it, things like that. And then if they're doing, let's say, a $60,000 construction budget and we do 3 or 4 draws, I'm out there 3 or 4 times. Within 5 months, I see the borrower 5 times. You think they're going to go to somebody else if you're in front of that person, every few weeks or every month? Every time I'm there, hey, You have another deal you're going to be looking at. You have any friends that potentially are doing a deal, another real estate investor partner doing a deal. Is your contractor do deals? Like you're meeting people, you're out there doing that. So we did all of that ourselves for a long period of time. And then we went into the third party realm where we had people, real estate agents, real estate investors, things like that, inspectors that would help us be our eyes and ears on the street. And we had multiple people that would do that, pay them a small nominal fee. And we are like, you know what? This is a position we could bring in house. We're making, $400, $500 on the front end on every valuation or inspection. Plus we're doing 195 draw fees. So on an average deal, we're making about $1,000 in additional fees on some of these things. We can certainly support a full-time inspector, gets a company truck, goes out to every property and, meeting the borrowers and in essence, help generate more business from that. So at some point you can do that and also an originator. Now I believe that most hard money lending operations should be definitely underwriting deals, but should have involvement with the borrowers on the front end. So you understand what their questions are. You learn a lot by talking to a lot of people, and you're going to be the ones making the rules if you want to lend to them or not. And obviously you need to know about their characteristics. So I think that should be the owner's job. But then after you grow into a bigger portfolio, certainly hire an originator. I don't think any of these things should really be outsourced. Maybe the inspector, but there's companies that do third-party processing. There's companies that do third-party bookkeeping. I think it makes sense to keep that stuff in-house. And at the right size portfolio, you can support it. So that's in-house. And then outsource, we work with lots of attorneys, insurance companies, brokers, inspectors, realtors, contractors. So attorneys, we're using an attorney that does our loan docs and our title review. We're using an attorney that does all of our defaulted work, foreclosures, foreclosure work, things like that, judgment work, things like that. If you need referrals for anything, comment below this video. Happy to chat. We have insurance providers for title insurance. We have insurance for property insurance. We have insurance for forced place builder's risk insurance. So for instance, let's say a borrower stops paying their property insurance. Well, we need to do a forced placed lender policy that covers us as a lender. And we also have like commercial liability, policies on insurance. We work with lots of brokers. 10 to 20% of the loan volume that we do comes from mortgage brokers. And we market for brokers just like we market for borrowers. We do a lot of website stuff. We do a lot of offline stuff, meet them at meetup groups, things like that. Go by their offices, call their offices. Again, our inspectors internal, but you could get a outsourced inspector. Most real estate agents, realtors, or maybe even appraisers can help you with this. I would say the going rate is probably $100 to $150 to do an inspection for you, and they can be your eyes and ears. You just need to train them and explain to them exactly what you're looking for. We work with realtors that refer us deals and potentially work with contractors if we need, potential help on a deal that we foreclose on or something like that, but not as much. And those are outsourced people, and that makes up our real estate team. And again, like we started this conversation with, like these are the 3 costly mistakes that you must avoid if you're lending money. You must avoid setting these up the wrong way. If you set this up the right way, good things will happen. Remember, you do good deals on the front end, you'll have a clean portfolio, you'll have very happy capital investors who want to reinvest and do more deals with you, and it'll just be more profitable. You can't be doing bad deals. Bad things will happen. So again, if you want to learn directly from me and get access to all of our systems and processes, literally everything to make sure you scale your lending business profitably and the right way and avoid all of these costly mistakes, click the link below and apply. And I'll see you guys on the next video.